Hello, good morning, and welcome to the Business News brought to you by Blytheway. I'm Charlie Gibson. Now, as we all know, one of those things that's most highly valued by investors, certainly traditionally and possibly now more than ever, is their return in terms of the income stream. And in this case, I'm talking about dividends. Well, this morning, we're talking to a company that has reported its third solid interim dividend in a row of sixpence halfpenny. And joining me now is the chief executive of that company. The company is Central Asia Metals, affectionately known to almost everyone as CAML, and the CEO is Nigel Robinson. Nigel, very good morning. Thank you very much indeed for joining us.
Morning, Charles.
So sixpence halfpenny, the dividend for the third year in a row. And we know that the final is not a mirror image of the interim, and for the last 2 years it's been higher, hasn't it?
It has been higher, yes. Halfway through the year, we always look at the markets and see what we can afford. We have a dividend policy that is based on cash flow, and we've put in a good performance in the first half of this year, and we're comfortable to announce something which is consistent year on year for the interim dividend. We will look at the final dividend, obviously, in light of the performance in the second half of the year, but we'd like to think that we can perform a consistent basis for shareholders and return money consistently.
So, and usually I end my interviews with let's talk about the dividend instead. But the thing that really stands out here is that sixpence halfpenny in the first half. If you were to do sixpence halfpenny again, 13 pence for the whole year, you would still be yielding somewhere more than 5%.
More than 5%, certainly. Closer to 7%, I would argue. And we will certainly be, looking to pay more than 6.5 pence in the second half of the year to make a final dividend beyond 2 times 6.5 pence, if you like. We've done that historically, and we've no intention of changing that. Which
must put you in, the top quartile. I mean, amongst the top dividend yielders of the mining companies, certainly in the market globally, probably.
I would suspect so, yes. In terms of AIM-listed companies, if I go back probably 8 and 9 years when we listed back in September 2010, within 2 years of developing the Kounrad project, we were into paying dividends. So we've got a good track record now of consistently paying back dividends to our shareholders. 6.5 pence for the first half of this year will then take us up to 98 pence that we've paid back to shareholders, $176 million back to shareholders since 2012, which shows that we've been doing it for a while. We've got a good track record of it. We have a policy, which, as I say, is a percentage of cash flow that we pay back to shareholders, but we also do look at the absolute amount of money that those shareholders may be expecting us to pay them back.
So I assume that your shareholder register is probably packed full of income funds, amongst others.
It's a mixture. It's a mixture of growth, income funds, but I think at the moment in this current market environment, a lot of our investors are looking to us for a safe haven. They're looking for a bit of security. They're very much risk off in the current commodity price environment, and therefore I think the sustainability of a dividend, an attractive dividend back to them, is something which stands us out from the rest of the marketplace. A good mining company, but also a good investment opportunity, whether you're in mining or whatever investment sector you are in at that time.
So I said we usually end by talking about dividends, so why don't we go back to the beginning of the interview?
Let's go back to the beginning.
Tell us a little bit about those first half figures that you've announced.
We're pleased with the numbers. We've had a good first half to the year, as I say, against a quite challenging commodity price environment. Operationally, we've delivered in terms of the copper, zinc and lead that we produce. We're on track for our guidance for the year. The guidance for the year for copper is 12,500 to 13,500 tonnes from the Kounrad operation in Kazakhstan. And for zinc and lead in concentrate, we're targeting this year to do 22,000 to 24,000 tonnes of zinc in concentrate and 28,000 to 30,000 tonnes of lead in concentrate. The production numbers announced this morning, in fact the production numbers themselves were announced earlier in the year, show that we're well on track to meet that guidance. Financially, we've had a good half as well. As I say, challenging price commodity outlook, but we can't influence that necessarily. But we've controlled the cost well, such that our EBITDA margin has remained period to period with H1 2018, 63%. So we're managing the cost well in a difficult environment, and therefore that is helping our cash flow. And in fact, the cash flow that we pay the dividend against, the free cash flow, has gone up $3 million when compared to the same half-year period in 2018, because we've controlled capital expenditure and operating expenditure to give us that pool of money, if you like, against which we pay back money to repay the debt, as well as repay our shareholders some dividends.
So speaking of which, let's talk a little bit about the balance sheet and the cash flow statement.
Yep.
You've got 100-ish million of net debt
We're
left on the balance sheet?
reporting this morning a net debt of $100.2 million. So that's a combination, obviously, of cash that we have in the bank of $30 million and gross debt outstanding with our bankers of $126.4 million.
And that's down from $200-ish million
Well, absolutely, yeah.
a couple of years ago, 2 or 3 years ago.
November 2017, you'll recall, we acquired the Sasa mine in North Macedonia, a zinc and lead mine. We acquired that for $402.5 million, of which about half of that was debt. And since acquiring Sasa, we've now paid back $88 million, deferred consideration to the previous owners, and in terms of paying back debt on the principal debt to the bankers, we pay back about $38 million every single year, and we're consistently doing that, such that we would project that we will have paid off all of the debt in about 2.5 years' time now.
Which brings us seamlessly back to the dividends, because at that point, whatever it's done between now and then, and we appreciate that it's been steady, it's certainly in the first half of the last 3 years, but there is a potential for the dividend to rise again.
There is, but I think as a management team, what shareholders want is both a sustainable dividend as well as capital growth. In the current challenging markets, the capital growth is probably our lower priority, the kind of growth of the business. Our main capital allocation priorities at the moment are to deleverage, to pay off the debt, as I mentioned, maintain a good dividend for our shareholders, and then whatever spare cash we have in treasury or debt capacity we build up from paying the current debt off, we will then look at other opportunities, or if there are no other opportunities, we'll pay back to shareholders.
What are your feelings on, or what are your limits when you say you look at those opportunities? I imagine that bankers and brokers must be bringing you opportunities almost all of the time, as is their nature. But I mean, and obviously I'm not I'm not asking you to say we're looking at this company at the moment, but in terms of, I suppose, geography, in terms of commodity, what's the sort of strategic direction you're thinking?
Well, I think the strategic direction of the group has been set by what we've done over the past few years, effectively. In terms of metals, we'll probably stick with our base metal portfolio of copper, zinc and lead. Of those three metals, I would say probably the most attractive from our point of view is copper. Gold is obviously very good at the moment in terms of the price. You often find gold with copper, so we wouldn't rule that out necessarily, but I don't think we'll be going just for a pure gold asset as such. Geographically, I've said this in the past in interviews with you, I think, Charles, we're a little bit agnostic, although there are certain places we wouldn't touch. But I think the key thing for us as a kind of strategy to grow the business is the fiscal discipline and the kind of capital allocation decisions we always challenge ourselves with. First of all, pay the debt down, maintain a good dividend to shareholders, grow at the appropriate time in the market to maintain that kind of fiscal discipline.
What sort of size? Do you have any limits on the sort of size of operation?
No, but I mean something of the magnitude of the Sasa transaction, $400 million, would probably the level we'd be looking for. But it's difficult. It is opportunistic. I've said this as well in the past, and I'll make no bones about that. Certain opportunities arise and you would look at maybe slightly more or slightly less, depending on the return on the capital that you have to invest in on that particular opportunity and whether or not you can maintain the dividends for going forward. And I think it's certainly true to say one key message we have from our shareholder base is that we must maintain that dividends. That's what sets us apart from our peer group, effectively. So, yes, growth, but not at any cost, and certainly not in any rush to grow the business. Let's maintain the structure that we've got. We've spent quite a bit of time bedding the Sasa operation into the way that we run our businesses. We're well down the path with that, and so now it's a question of maintaining that discipline. What I say are fairly tough markets, really.
You've mentioned that word challenging a couple of times, and obviously the market's view has shifted quite markedly in, I would have said, the last 6 or so months from an economic growth to a not economic growth outlook. Copper's obviously reacted to that, and gold has reacted in the opposite direction to that. Copper's had a little bit of a bounce recently. How do you see the outlook in terms of the macro picture?
Yeah, I mean, I agree with your sentiments there. Certainly over the past 6 months, we have seen a deterioration from risk off with the investors because of we do live in very volatile times at the moment. I mean, be it Brexit, be it the trade wars, which are probably far more important, be it the drone strikes in the Middle East this morning. So the world is a pretty volatile place at the moment, and therefore as a consequence, you're finding people becoming slightly more bearish about the whole economy as in general. And copper is a bit of a bellwether on the economy, as we all know. And therefore, when that happens, you seem to see the demand for copper is driving the current, what we would argue are fairly lowish prices for copper. Longer term, if you look to the actual supply side of the copper market, certainly most analysts and most commentators would say that there will be a deficit when maybe nobody can put the timing on, but there will be a deficit in the future years from the medium to long term is what people see. I think the zinc and lead markets, slightly different markets, maybe slightly more challenging at the moment with the impact on the automotive industry for zinc and lead. But again, similar kind of challenges coming out of China for actual growth for those markets in terms of the prices for them.
But worth mentioning that the margins you make are quite special.
Absolutely, standout margins. I mean, 63% EBITDA margin is good in any industry, and therefore that is our whole business model. I've said this before. The way we operate is to produce safely, is to produce to whatever we say to the market in terms of meeting our delivery targets for production guidance. But most importantly, we make sure that we keep a low cost base. And if you're in the lowest quartile or just on the cusp of the lowest quartile, which is where we are at Sasa for zinc, then you can maintain a business when the products that you sell are coming under pressure in terms of prices. And so 63% EBITDA margin feeds through the whole business to give us the free cash flow to enable us to pay the debt down and maintain a good dividend to shareholders.
Nigel, thank you very much indeed. Come back and tell us in 6 months how the rest of the year has gone and how the outlook has gone from your expectations. Ladies and gentlemen, that's Nigel Robinson, the CEO of Central Asia Metals, affectionately known to everyone as CAML. As I say, I'm afraid that's all we've got time for today, but we'll be back with more such opportunities for you in the very near future, we hope. But until then, this is me, Charlie Gibson, signing off for the Business News brought to you by Blytheway. And until that time, you have a very capital day.